Hi, I'm Tess Downey, founder of Complete View Financial, and welcome to this month's video blog. Today I want to talk about a couple of things. I want to start out by first giving a brief recap of market performance and then delve into the differences between lump sum investing and dollar cost averaging. So let's start with the recent market performance. We know this year has been a crazy ride, starting out with great performance in January and February, and then obviously the large market decline we experienced in March, early April, and then with the very high rebound that we experienced at the end of the second quarter and are so far seeing today. So here's a quick overview. Year to date, the S&P 500 is up over 5.5%, and for the trailing 12 months, up over 21%. The MSCI EAFE total return gross, or international markets, are down 5%, and the trailing 12 months are actually up 7.33%. Bloomberg Barclays US Ag, which is a fixed income index for the US bond market, are up 6.85% year to date, and for the trailing 12 months are up over 7%, which is really remarkable. Second quarter in the US market was really one of the best quarters since 1998. Equity markets around the globe posted positive returns in the second quarter. U.S. equities outperformed non-U.S. developed markets or international markets as well as emerging markets, and value stocks underperformed growth stocks, and small caps outperformed large caps. REITs, or your real estate investment trust, underperformed equity market indices in both U.S. and non-U.S. markets. So let's shift gears a little bit and talk about the differences between lump sum investing and dollar cost averaging. So lump sum investing is essentially investing the full amount of available capital immediately into the market. Examples of a lump sum investment might be receiving a large inheritance, deciding to receive the lump sum payment instead of a pension payout for your retirement, a large cash bonus or commission at the end of the year. When thinking of a lump sum investment, you really need to make sure you're understanding your risk tolerance and then putting this cash into play in the overall context of your overall asset allocation or investment plan. On the other hand, we have dollar cost averaging. Dollar cost averaging is obviously investing contributions over periods of time. The idea that it's helping investors diversify the cost of entry into the market so that when you buy in, you're buying at different prices depending upon the day you buy in, so that over time you're averaging your buy-in price. Behaviorally speaking, this can benefit many investors that might be a little nervous about jumping into the market with something they've worked really hard for their entire life, like a retirement payout. Putting it all in on one day can be very nerve-wracking, and so it can help from a behavioral standpoint. But the downside of dollar cost averaging is that while you begin to implement this plan, you have an opportunity cost, and that's the cash sitting on the sideline, which is essentially earning maybe minimal interest, but it's not earning equity-like returns or bond yields. And so the downside of dollar cost averaging is essentially that cash on the sidelines waiting to be invested. So what does the data show? What is the best approach to take? Lump sum investing or dollar cost averaging? So this exhibit puts those figures in a broader context. It shows the average annualized compound returns of the S&P 500 from 1926 to 2019. After the index has hit all-time highs, the subsequent 1, 3, and 5-year returns are positive on average. After the S&P 500 has fallen more than 10%, the subsequent 1, 3, and 5-year returns are also positive on average. Both data sets show returns that outperform those of 1-month Treasury bills. Overall, the data do not support the recent market performance. That recent market performance should influence the timing of investing in stocks. So what does all this mean? So when theory and data support lump sum investing and agree that is the most efficient way to build wealth over time, what do you do if you still don't feel comfortable? Well, there's nothing wrong with dollar cost averaging. It can make a lot of sense, and behaviorally, if it allows you to get into the market while sleeping at night and having a peace of mind, I think that is very important to consider. And so over a long period of time, we know lump sum investing can build more wealth, but if dollar cost averaging is allowing you to sleep at night, there's nothing wrong with that either. At the end of the day, I think the goal is to find what approach works best for you and working in conjunction with your financial advisor, implementing that plan, and then sticking with it over a long period of time. Thanks for listening in to this month's blog post.